Welcome to The Explainer. Today we're going to break down a pretty dramatic scenario in the precious metals market. This is all based on a real-time analysis of what could happen on a day like, say, January 12th, 2026.
Okay, let's just dive right in with a single, startling number that, in this scenario, popped up on dealer websites over the weekend. $100.
Now, you're probably thinking, $100 for what? A big bar of silver? No. We are talking about a single 1-ounce American Silver Eagle coin. And according to this market analysis, the answer is a shocking yes, that's the price.
And this is where the mystery really begins. You see, while the official spot price of silver, that's the number you see on the news, closed at $85.55, the actual price to buy and hold a physical coin in your hand soared past the $100 mark. So how can one thing have two totally different prices at the exact same time?
Well, that massive gap between the two prices brings us to the absolute core of what we need to understand today, the huge difference between the paper price and the real price.
Analysts have a name for this. They call it the premium gap. Just think of it as the growing space between the paper price you see on TV, which is based on contracts for silver to be delivered in the future, and the real price you actually have to pay a dealer to get that metal in your hand. It's like a divorce between two prices that are supposed to be married.
The source we're looking at explains it like this. That $85 paper price, it's really just a bet on the future price, traded on an exchange. Most of these bets, believe it or not, never end with anyone actually getting any physical silver. But that physical price, the $100 plus, that's what you actually pay for the real, finite metal that you can hold.
And the source uses a brilliant analogy to really drive this home. Think of it like trying to buy concert tickets. The venue's official website says the price is $85, but guess what? They're all sold out. The only place to get one is from a guy outside the stadium who's selling them for $100. Well, that $100, that's the real price. The $85 price is just a ghost on a screen.
And to put this all in perspective, the premium, that's the extra bit you pay over the official spot price, is normally just a few dollars, maybe $3 to $8. But in this situation, that premium is absolutely ballooned to over $17.50. That's a 17% markup just to get the physical coin. It's a gap so wide the source actually calls it a market divorce.
So what could possibly cause a sudden divorce like this? Well, let's look at the catalyst. According to this analysis, it isn't just a simple supply and demand problem. No, this is about a crisis of trust.
The source material claims the whole thing was triggered by bombshell news, the Department of Justice launching a criminal investigation into the chairman of the Federal Reserve. The argument is that this event would shatter the public's trust in the Fed's independence, causing a massive safe haven flight as people just scrambled for physical assets they could actually, trust. If you're finding this explainer helpful, please take a moment to like, share, and subscribe so you won't miss any of our future breakdowns.
Okay, so how might the financial system react to this kind of intense pressure? Well, the source points to a pretty famous historical event as a potential playbook for what could happen next.
And that brings us to the Hunt brothers incident way back in 1980. You had two brothers who started buying up enormous amounts of physical silver, and they drove the price from $6 all the way up to nearly $50 an ounce. The establishment started to panic. So what did they do? The exchanges changed the rules of the game right in the middle of it. They jacked up something called margin requirements, which made it way more expensive for the brothers to hold on to their silver contracts. It forced them to sell, which flooded the market, crashed the price, and drove them into bankruptcy.
So the crucial lesson that the source takes from this event is pretty simple. When the price of silver starts to threaten the established system, there's a history of them just changing the rules.
But the analyst here argues that this time is completely different. Back in 1980, the buying was coming from just two speculators who were trying to make a profit. But in this 2026 scenario, the source claims the buying is a decentralized wave. It's coming from sovereign funds, big institutions, and just regular folks like you and me, all driven by fear and the desire to preserve their wealth.
So that brings us to our final section. Given this very unique situation, what are the key things to look for? What possible scenarios is the source material focused on?
All right. In what the source calls a conservative scenario, let's imagine the official paper price hits an even $100. If that 17.5% premium we talked about holds steady, the real price you'd actually pay for a coin would be about $117.
But then there's a more extreme stress test scenario. This one gets fueled by rumors, unverified rumors, that a major vault in London can't deliver physical silver to a big buyer. If that kind of panic were to escalate, the source suggests premiums could hit 50%. That would mean a physical price of $150, while the price on the screen is still just $100.
So what should we be watching for? The source points to 4 key signals. First, any sign of those exchanges hiking margin requirements again. That's the classic move to cool off a hot market. Second, the gold-to-silver ratio. If it drops below 50, that could signal a silver buying frenzy. Third is simple, just the inventory levels at coin dealers. And finally, any kind of coordinated shift in how the mainstream media starts talking about silver.
And this is fascinating. This slide lays out the author's personal battle plan, and they're very clear this is not financial advice. It's a disciplined approach that uses specific price triggers to decide when to buy, hold, or sell. The whole point is to take emotion and news headlines completely out of the decision-making process.
So if you take just one thing away from this whole analysis, let it be this. You have to distinguish between the ghost price you see on the news ticker and the real price you would actually pay at a dealer. According to this source, they're just not the same thing anymore.
And that really brings us to the final, provocative question that goes way beyond just the price of silver. The source asks us all to consider this. If trust in our core financial system really does break, how do we figure out what anything is truly worth?